Today, we're diving into the world of crude oil, one of the most important and widely traded commodities on the market. In this video, I'll be discussing what affects crude oil prices and why it's essential to keep a close eye on the market. Before we dive into the factors that can impact crude oil prices, let's start with a brief overview of what crude oil is and what it's used for. Crude oil is a fossil fuel that is extracted from the ground and processed into various products, including gasoline, diesel fuel, jet fuel, and petrochemical products. It's an essential resource that drives the world economies and affects nearly every aspect of our lives. Now, let's take a closer look at 5 factors that can impact crude oil prices. The first and most significant and obvious factor is supply and demand. When the demand for crude oil is high, prices tend to rise, and when demand is low, prices tend to fall. It's a simple principle of economics. When there's more demand for a product than there's supply, the price goes up. Another major factor that affects crude oil prices is geopolitical risks. Conflicts, tensions, and disruptions in oil producing countries can have a significant impact on the supply of crude oil, leading to higher prices. For instance, recent tensions in the Russia Ukraine have raised fears of oil supply disruptions and led to an increase in crude oil prices. Geopolitical risks refer to any political or social events, conflicts, or tensions that can disrupt the production or transport of crude oil. These risks can come from a variety of sources, including war, civil unrest, terrorism, and political instability. When a major oil producing country is experiencing geopolitical risk, it can lead to supply disruptions and higher prices. For example, if there's conflict or unrest in a major oil producing country, it can lead to the shutdown of oil production and a decrease in supply, causing prices to rise. Similarly, if there's a risk of terrorism or sabotage to oil pipelines or shipping lanes, it can also disrupt the supply of oil and lead to higher prices. Geopolitical risks can also have a knock on effect on the global economy, which in turn can impact crude oil prices. For instance, if a geopolitical crisis leads to a global economic shutdown, it can decrease the demand for crude oil and put downward pressure on the prices. The state of the global economy and the value of the US are also critical factors to consider when it comes to crude oil prices. A strong global economy means higher demand for crude oil, which typically leads to higher prices. On the other hand, a weak global economy means lower demand, which puts downward pressure on crude oil prices. The value of the US dollar is also crucial because it affects the cost of crude oil for buyers using other currencies. It's essential to keep an eye on the value of the US dollar, especially for those who are actively trading oil. The US dollar is a major currency and is used in a significant portion of global trade, so any changes in its value can impact the price of crude oil. OPEC, or the Organization of the Petroleum Exporting Countries, is another critical player in the oil market. OPEC is a group of oil producing countries that work together to regulate the supply of oil and control prices. Any changes in OPEC's production quotas can have a significant impact on the price of crude oil. Let's dive a little deeper into how OPEC affects crude oil prices. OPEC is made of 14 oil producing countries, including some of the world's largest exporters such as Saudi Arabia, Iran, Iraq, and Venezuela. These countries work together to regulate the supply of oil and maintain stability in the oil market. OPEC's main goal is to keep oil prices at a level that is acceptable for both producers and consumers. OPEC achieves this goal by setting production quotas for each member country. When demand for oil is high and prices are rising, OPEC may reduce its production quotas to keep prices from getting too high. On the other hand, if demand for oil is low and prices are falling, OPEC may increase its production quotas to support prices. These decisions by OPEC can have a significant impact on the price of crude oil. For instance, if OPEC decides to cut production quotas, it will reduce the supply of oil and cut prices to rise. On the other hand, if OPEC increases production quotas, it will increase the supply of oil and put downward pressure on prices. It is important to note that not all OPEC countries always adhere to the production quota set by the organization. Some countries may choose to produce more or less oil than their quotas allow, which can have an impact on the supply of oil and prices. Finally, market sentiment is another factor to keep in mind. This refers to the overall mood and confidence of traders and investors in the market. If the market sentiment is positive, price of oil is more likely to go up, and if sentiment is negative, the price is more likely to go down. To summarize, crude oil is a highly traded commodity whose price is impacted by a multitude of factors. Keeping an eye on these factors is essential for anyone who wants to make informed investment decisions in the crude oil market. By understanding how these factors influence the price of crude oil, you can better predict market movements and identify profitable trading opportunities. That's it for today's video. If you like what you learned, please hit the like and subscribe button. Thank you.